we have some key things that you must know. Key points here. Key points. One, we needed to know what are types of share-based payments. And their impact and their accounting treatment. Then number two, we needed to know how to deal with deferred tax implications of share-based payments. Then we needed to know repricing of share options. Then lastly, it's good to know disclosures. So these are some of the key things that we must know. Initially, there was no this standard, and the main objective is to prescribe the accounting and disclosure requirements of the entity share-based transaction. So you will read through these definitions, and I'm going to be talking about them when we are handling numbers. Okay, but key thing you need to know is that this standard, we have the scope where you cannot apply this standard, especially if you issue shares in a business combination. We looked at that. If it is a business combination and you're issuing shares, then we apply IFRS 3. We looked at that when we are dealing with consolidation. Okay, if you're issuing shares in a way of the public to buy shares from you, then that cannot be share-based payment. You cannot apply IFRS 2. Also, you cannot apply this standard in transactions with employees or other party in their capacity as shareholders. Here, if the employee, if you as the worker, you have capacity to buy shares in a company, there we are not talking about IFRS 2. No, you have the capacity to buy shares. Okay, and it also does not apply at share-based payment transactions other than acquisition. This one is in a situation like share dividends. If you're offering share dividends, there is no way you're going to apply this standard. If there is a purchase of treasury shares, if there is issuance of additional shares, you cannot apply this standard. Share dividends, you know that these are distribution of profits to shareholders based on the number of shares they hold in a company. Purchase of treasury shares, this is when a company buys back its own shares from the market. And in that scenario, ideally, that transaction does not relate to share-based payment. You're just buying your own shares from the what? From the market. Okay, so basically that is the scope. If they ask you where this standard does not apply or exemptions to this standard, please take note of these three. They are very, very key. Okay, so what are types of share-based payments here that we normally look at when we are handling this standard? One, we look at equity. We look at equity share-based payments. And what is equity share-based? It is equity settled. Put that word, equity settled share-based payments. Here, these are share. I can abbreviate as share-based payments that result that results into equity and expenses. These are share-based payment that result into equity and expenses. And you need to know that with equity settled share-based payment, they are measured using fair value at grant date. And examples of equity, here examples of equity settled share-based payments. We have, you can talk about the common one is share options. So if you're dealing with a question and you see the word share option, then think about equity settled share-based payment. You're going to measure this share option using fair value at grant date. So key thing is that when you're looking at equity settled share-based payment, know that these ones will result into equity and expenses. It means that you'll be debiting expense and crediting the equity. But as we measure, we are going to be measuring using the fair value at grant date. What is grant date? It's something that you must also understand. I included that in our handout. And a grant date is the date on which the entity and the counterparty, that is maybe an employee, agree to a share-based payment arrangement, being when the entity and the other party have a shared understanding of the terms and conditions of the arrangement. Let me just try to summarize. A grant date is the date on which the counterparty, for example, employee, is offered a right to acquire shares in an entity. That's just the summary. On the date you agree, on the date you're given a right to acquire shares in an entity, we call that date a grant date. Okay? So we will be asking ourselves, what is the fair value at the grant date as we measure this equity settled a share-based payment or this share option? We'll be asking ourselves, what is the fair value at the grant date? The date you are offered a right to acquire shares in an entity. Okay? So next, another type is a cash settled share-based payment. With cash settled share-based payment, these results result in employee expenses and the employee liability. They are measured. Remember, the first one, equity settled, are measured using the fair value at grant date. But this one, they are measured using the fair value of appreciation rights at each reporting date. Price, what is the fair value of your share appreciation right? Okay, for us to measure cash settled examples include here, it's share. One of the examples that we normally talk about here is share appreciation rights. You have worked for, let's say, a company for 20 years. You have worked for your boss appreciation. They give you share appreciation rights. Okay. The first one, as an appreciation for your efforts, they award you share option. Here they award you what we call share appreciation rights. Okay. And these share appreciation rights they are in the form of cash. They are going to be settled using cash. But here the first one with equity, how it is going to be settled, no cash. Instead, you are given a right to buy shares, share option. That's why we said it is share option. At the end, once you meet the conditions, they normally put some time frame. If you work for us, like let's say 20 years, then after 20 years or after 10 years, we are going to give you a right to buy shares in our company. That is equity settled. Here, if you work for us, let's say 15 years, we are going to appreciate you with what we call share appreciation rights. And these share appreciation rights here, you are not given a right to buy shares. Instead, the company will reward you in the form of cash. Okay, so you differentiate between the two. The first one is settled. The debt is settled using equity. It's in the form of equity. Here, it's cash. Okay, and that's why we are saying here it will result into an employee expense. Remember here, we are in the books. As we look at this standard, we are in the books of the employer. We are in the books of the employer as we look at this standard. So the employer in his book, he will be recognizing employee expenses, debiting employee expenses here. You debit employee expenses, then you credit what? You credit a liability, employee liability. You have not yet, at the time you agree that you will make a payment, when this passes to recognizing every year. That's why we call it employee liability, because you have not yet settled that promise. You'll be recording in your book as a liability. Okay. The first one, we said that you debit employee expenses, and credit what? You credit the equity. That was equity settled. Okay. So these are very common ones. These are two types that are common, and you must know. When you want to determine the value, please know that with cash settled, we look at the fair value at each reporting date. That is if it is cash settled. If it is equity settled, we look at the fair value at grant date. So in an exam, you have to look at the question and know what are these values. If you mix, then of course you are going to fail. Okay, so we are going to look at some examples before we talk about repricing of shares and the deferred tax implication. Let's see how can we tackle a question related to this. I believe you have the questions that I shared. Let me open here my laptop. I'm just open here. Which screen are you seeing?
Excel.
Okay. Okay. Let me open how you're seeing questions.
Yes.
They are telling us question 1. On the required part, we show how Zul should account for the share options. Now, if you see the word share options, in your mind, you should think about something. How are you going to measure share options? Okay. Is it a cash settled or it is settled? Something how Zul should account for the share options. This is equity settled share-based payment. So how can we account for the shares in each of the 4 years in accordance with IFRS 2? Okay, so they are telling us that on 1st January 2018, Zul granted 1,000 shares option to each of its 500 employees on a condition that now colleagues, when they are giving you these kind of options, of course there must be a condition. We normally call that one vesting condition. In your handout you have that. Which screen are you seeing?
Questions. Okay, now the vesting conditions are on the screen.
Okay. I believe you're seeing a handout. Let me hope you're seeing a handout. I want you to look at the definition of vesting condition. These are conditions that must be satisfied for the counterparty, that is employee, to become entitled to receive cash or other assets or equity instruments of the entity. So you, the boss, you, the employer, you must state those conditions. And these conditions can be service condition or performance condition. Service condition, it's just here we are looking at a condition that require the employee to complete a specified period of service to the entity. Here you're given a number of years. Maybe the company is saying, if you work for us like 10 years, you'll be entitled to share options. That is service condition. Here we don't talk about the performance target. Here, there is no performance target. Here, we just talk about the number of years you must work for us. That is service condition. Then with performance condition, it's the condition that requires specified performance target. Now here, if you meet the target, the company is going to give you target. If we hit our target, then you will be qualified for this. So here, with performance condition, we look at the performance target. At the same time, we also look at the number of years you have worked for us. Okay, so it's something that you must know. And I included more vesting conditions. Of course, non-market-based vesting conditions and market-based vesting conditions. With market-based, vesting conditions, here we look at, they are linked to the market price of the shares of the company. But here we are not ideally looking at what? We are not with non-market based vesting conditions. We are not looking at the market price of shares. We are just looking at the minimum period you can work for us, the minimum revenue as your target, maybe the profit. Here they set for you the what? They set for you some conditions, not based on the price of the what? The price of the shares. With market-based vesting conditions, we are looking at the market price of the shares of the company. Has it increased? If the market price of our shares increase, then you are going to qualify for some what? For some benefit. The shareholder return, among others. So try to read it through. I believe now you have a hint and it will not be hard for you. So let's go back at our question. Okay, are you seeing the question?
Yes.
Okay, so we are saying that on 1st January 2018, Zur granted 1,000 shares option to each of its 500 employees on condition that employees will remain in service until 31st December 2021. So this is like what? This is like service condition. You must remain in our company up to this date, okay? The fair value option at the grant date. Why are you given this fair value? Because here you're dealing with share option, which is equity settled. And we said that equity settled share-based payments are measured using fair value at grant date. Okay, so they are telling us that this fair value at grant date was shilling 1,200. Zur estimates that 100 employees will leave during the vesting period. That is the estimation, okay? And they are telling us that during the year 2018, 30 employees leave, or you can, I think I was supposed to put left. During the year 2018, 30 employees left the company, and Zur estimates that a further 80 employees will leave in the remaining period. In 2018, 30 employees left, but still the company estimates that 80 employees will leave in the remaining period. That is 2019 and 2019, 2020 and 2021. Okay. During 2019, 35 employees left, and the entity estimates that a further 65 employees will leave during the remaining period. The remaining period, that is 2020 and 2021. During 2020, employees left, and Zur estimates a further 35 employees to leave. And also they are telling us that Zur estimates that a further 35 employees will leave in year 4. Year 4, that is our 2021. In 2021. So how can we account for share options in each of the 4 years? Okay. So let's start. This is question 1. We are going to write something. We are going to say that share options. Share options are examples of equity settled share-based payment that result into what? We said it results into what?
Employee
Share
equity
options.
and
Share options are examples
employee
of
expenses.
equity share-based payment that result into equity
And expenses.
and employee expenses. That is number one. Okay. Then we say that IFRS 2 requires an entity, and for now this is zoo, to measure equity settled based payments using what? Using the fair value
grant date.
of options at grant date. Okay. So once you know this, start by, okay, in an exam, we don't say this, okay? Just for discussion. Start by determining the remaining employees. Because remember, we want to account, for you to account, let's first know what is the remaining employees for each year. Because we have the formula that we follow, colleagues. We have the formula that we follow as we account. We are going to see that, yeah? So, start by determining the number of employees for each year. We start with our first year. Our first year, that is what? Which year? It was 2018. 2018. We need the remaining employees. How do you get remaining employees? You are going to get the total employees. Remember, these shares were granted to each of 500 employees. Okay, anyone who can qualify as long as you meet the condition. So we are going to get total employees. We get here total employees, that is 500 employees. Then we subtract the number of employees that left in 2018. How many? How many employees that left in 2018? During the year 2018, 30 employees left, okay? So we are going to remove that. Then you also remove the estimated number to leave. And basing on our question, how many employees are estimated to leave in the remaining period? A further 80 employees will leave in the remaining period. So you also subtract that. That is 80. What do you get? 500 minus 30 minus 80. That's what I have, okay? These are remaining employees in 2018. What about 2019? We do the same. We do the same. That is our second year. 2019. I believe now you know what we are doing. You get your total employees minus, now for 2019, we get total employees minus the employees that left, the actual employees that left in the previous year. The actual employee that left are how many? 30 employees. You don't remove the estimate for the previous year, you just remove the actual number of employees that left. Then you subtract now in 2019, how many employees left in 2019? How many? In 2019, 35 employees left. And they are telling us that the entity estimates that a further 65 employees will leave during the remaining period. So we are going to get 30 employees that left in the previous year. Then we subtract 35 that left in 2019. Then we subtract the estimate for 2019. How many are estimated to leave in the next period when you're handling 2019? And those are how many? 65, eh? What do you get? Let me hope colleagues we are following. We are together. Are we together? In case there is something not clear, you let me know. So here we get how many, the remaining employees, how many? 500 minus 30 minus 35 minus 65. Next, the third year, that is 2020. We do the same. Total employees 500 minus the employees that left in the first year, that is 30, minus the employees that left in the second year, that is 35, minus the employees that left in the third year, that is 2020. And in 2020, how many left? During 2020, 20 employees left. So we are going to remove 20 employees, then we remove also the estimate in 2020. Okay. So here we are removing 35. Wait, 20 left in 2020, then estimated 35. What do you get? This is 500 minus 30 minus 35 minus 20 minus 35. That's what you have on your calculator. Then our last year, that is fourth year, that is 2021. The total employees 500 minus the employees that left in the first year, that is 30, minus employees that left in the second year, that is 35, minus employees that left in the third year. How many left in the third year? That is 20. Then in the fourth year, how many? In the fourth year, they are telling us that Zur estimates that a further 35 employees will leave. Okay, so we remove that 35. We remove that 35. What do we get? It is 500 minus 30 minus 35 minus 20 minus 35. So we have the remaining number of employees for each year. Once you know that, it becomes very easy now. You will look for the we have two ways. You can use a table, or you can use just writings. You are going to use two methods. You will choose which one is easier. So we need cumulative. Remember here, we are saying that this share option, it's equity settled share-based payment that will result into equity and employee expenses. So we are trying to find what is the equity for each year, what is employee expense for each year. So what is cumulative expense cumulative expense or equity? How do you get the
Excuse
cumulative?
me.
Yes, please.
Yeah, this number of employees for third year and fourth year. I'm not getting a difference if I go back to the question. The question, we seem to be stopping at 2020.
Let's go back to the question. You see, this is, remember, we are looking at here, they are telling us that these employees must remain in the company up to what? 35 December 2021. It means that 2021 is inclusive, okay? Now, when you look at the employees left, and Azure estimates that a further 35 employees leave. Here, you're still dealing with 2020.
True.
Peter, are we together? Keep your mic.
Yeah, I'm getting you.
But
It's breaking. Here? I don't know if it's breaking my side. There's no network is breaking.
Yeah, you see my network are breaking. But now are you in a position to hear me?
Okay, now I can hear you. So 2020 is clear.
2020 is clear, okay?
Yes.
Here they are telling you that Zuru estimates that a further 35 employees will leave in year 4. What is your year 4?
2021.
That is 2021. That is the reason why I'm subtracting this 35. Because this 35 is the one in year what? In year 4. We are saying that get total employees minus employees that left in the first year. They were 30. That is 2018. Then subtract employees that left in 2019. That is 35. Then subtract employees that left in 2020.
Which is 20.
They are 20. You see that, eh? Then how many employees are estimated to live in year 4? 35. I think now it is clear.
Okay, so I think I was confusing by adding another that left 2021, which is the same as estimate.
Okay.
Okay, it's okay.
Okay. So let's get cumulative expense or equity for each year. Now, how do we get this? We have the formula that we follow. Remember, we are valuing our shares using fair value at grant date. So you will be getting your remaining employees for each year, then multiply by the fair value of each option at grant date, then times number of options, number of share options, then times the vesting fraction. This is what you need to know. Okay. So in year one, but I think the table can make this thing easier. That's, to me, that's what I have observed. The table makes this thing to be easier. But let's use two methods. Let's start with this one. In year one, that is in 2018, what will be your cumulative expense or equity? We follow. How many employees in 2018? 390 employees. We multiply by the fair value of each option at grant date. What is the fair value of each option at grant date?
1,200.
1,200, yes. But the formula is good. it's good to start with 1,200, then times number of share options. They are 1,000, okay, isn't it?
Yes.
Then times, how do you know the vesting fraction? The vesting fraction is you look at the year you're dealing with, then you ask yourself, in total, you have how many years? Here we are looking at 1 year at the first year, so it is 1 out of the total vesting period. 1 out of what? 1 out of 4. That is the vesting fraction. What do you get? Let's put some speed, colleagues. Let's put some speed. You will do the same for year 2. That is 2019.
117M.
You get the remaining employees at 370 times the vesting, the fair value of each option, 1,200. Then times the share options. Then here a vesting fraction. Here you are in year 2, so it will be 2 out of 4. Then next in 2020 you do the same.
2.2 million.
This will be
2.2
this
million.
Times 1,000. You'll be using your calculator. Maybe you will tell me the answer direct. Then here 2021, it will be the remaining 380 times here I have made a mistake. And then, sorry. This will be 1,200 times 1,000, then times 4 out of 4. Tell me the answer. Remember here,
2.2
what
million.
you're getting is amount, is shillings, okay? Here is what?
The second
first
one
one?
is 2.2 million. The second one.
2.2 million. Then the first one?
The third is 342 million.
Third one is 3.
342.
Then lastly?
456.
456 million. The first one?
117M.
117 million. Okay. So this is cumulative. This is cumulative amount, okay? But we need to know how much should we recognize in our financial statements for each year. These are just cumulative amounts, okay? So how much? So we are going to say that in each of the 4 years, Zul should recognize employee expenses and equity as below. So you start in year 1 in 2018. What should Zul recognize in profit or loss, and what should Zul recognize in balance sheet? Of course, here you are going to debit. We debit expenses. So you debit profit or loss account. Profit or loss account. Here, this is employee expenses. Okay. Of how much in the first year? It is this one, of course. Okay. Then you credit what, colleagues? You credit.
Same amount.
We credit
Equity.
we credit equity reserve. Okay. Equity. The same amount. That is the first year. Because the question said how should Zul account for share option in each year. You are done with 2018. Then 2019, as here we are. Here you see that when you look at your workings, it's like expenses here have your expenses have employee expenses have increased, isn't it? So an increase in an expense, of course, here this one is already in your book. This one already is in your book. So you in year 2 you will just recognize an increase only. So here you are going to debit an increase in employee expenses. Still it will be profit or loss. They will appear in your profit or loss as an increase in expense. So what is that increase? It's 2 million minus 117 million. What do you get?
105.
You get shillings 105 million. Then you credit, it means that your equity is also going to increase. So we credit equity reserve the same amount. You're done with year 2. The next 2020, you do the same. You keep monitoring. If it is an increase, obviously your expenses are going to increase. You debit still. Since it is an increase, still we are going to debit profit or loss account with an increase. We get this figure minus this. This is 342 million minus 22 million. What do you get?
120.
Pardon?
120.
120 million. Okay. So we credit equity reserve with the same amount. Then lastly, in year 4, that is 2021, we are going to do the same. Is it an increase? If it is an increase, we still do the same. Debit profit or loss account with an increase, that is 456 million. Then you subtract 342 million. What do you get?
114.
Pardon?
114.
114, yeah? Okay. So I believe you have picked this. We credit equity reserve with the same amount. You have accounted, and that's all. That's all. That's all. Any questions? So that's all about question 1. That's all about question 1. Okay, so we look at the next question. Now we are done with question 1. Colleagues, you will try question 2 in your free time. You will try question 2. But maybe let me clarify here. With question 2, I saw something that is different from question 1. VUL should account for the share options. Still share options, this is equity settled. Expense and equity for each of the 3 years. So, and they are telling us that VUL grants 1,000 share options to each of its 300 employees. So this is our total employees. Each grant is conditional upon the employee working for the entity over the next 3 years. This is service condition. VUL estimates that 1,750. Okay, and they are telling us that at the end, they estimate that 20% of the employees will leave during the 3 years period, and therefore forfeit their rights to the share options. Okay. In year one, that is the first year, 20 employees leave, and VUA revises its estimates of total employees departures over the 3 years period from 20% at 15%. Now, colleagues, this question is different from the first question. If examiner has given you this kind of statement, it's different from this. Here you know that 30 employees are going to leave in 2018, and you are told that a further 80 employees will leave in the remaining period. But here they are telling you that VUA revised its estimate of total employees departures over the 3 years. Here you're looking at what? You're looking at 3 years, not the remaining period. Over 3 years. So if you're given such kind of statement, for you employees, in year one, you simply get a total employees, then you multiply by the remaining percentage. Now it is no longer 20, but it is 15. So you get you get your 30 employees times 85%.
You were breaking that time, so we didn't get the full explanation.
Yes. Sorry. I was saying that, like in this scenario here, you are told that in year one, 20 employees leave, and VUA revises its estimates of total employees departures over the 3 years. This estimate looks at what? The overall 3 years. So it means that even this 20 employees is inclusive in this percentage. So when you're looking for remaining employees in year one, for you simply get the total employees, then multiply by the remaining percentage. From 20% to 15%, what is the remaining percentage? For you now, you will get
85.
For you, when you're dealing with this question, you will not look at 15. For you, you will get 5%. Question 2. Let's just get remaining employees. Remaining employees. Remaining employees. For year one, you will get your total employees. Total employees, that is 300 employees. Then you multiply by 85% direct. If you do this direct, then you'll be, or if you don't want to do this, then you'll get 300 employees, then minus open bracket 15% times the 300 employees. Because that 15% looks at all the 3 years. So it means that even those employees that left in year one are included in this 15%. Okay? So for you, you'll just simply get employees times the remaining percentage. Okay? Then in year two, you do the same. In year 2, you get 300 employees. 300 employees times what? 300 employees times what, colleagues? They are telling us that in year 2, a further 22 employees leave, but they are telling you that the entity revised its estimate of the total employees over the 3 years period. Still here, you're talking about 3 years period.
Not 78, eh?
From 15% to 22 employees times which percentage? 100 minus 22, what do you get?
78.
You get 78. So here you multiply by 78. That's how you will get the remaining employees.
How about the 20? How many?
Then in the final year, a further 18 employees leave. Then in year 3, you will simply get who can try in year 3? There is a question. Jenny, you have a question.
Yes. How about the 22, the further estimate in year 2?
Can't really hear you.
Try. Oh.
What are you saying?
I'm asking the further 22, we don't consider that in year 2.
Pardon? A further 22 employees. You are meaning this one?
Yes.
You see, in year 2, yes, they are telling us that a further 22 employees leave. Okay? But remember, they are telling us that the entity revises its estimate of total employees over 3 years period. So it means that here, the estimate looks at year 1, year 2, and year 3. So it means that even this 22 is inclusive, even this 20 is inclusive in the estimate. That's why you don't need to look at this 22. As long as they have told you that this percentage looks at the overall vesting period, then you look at that remaining percentage only. It means that this 22 and 20 is inclusive in this percentage. Jenny, have I answered you?
Yeah.
Then if in year 3 for you, you will simply get in year 3 what will happen? Who can tell me the remaining employees in year 3?
So year 3, I think we'll remove, like we did the other last question, remove what actually left in year 1 minus year 2 and 18 in year 3. We went with 240.
And you get what?
240.
140. Exactly. You get 300 minus the employees that actually left, that is 20 in year 1, minus those that left in year 2, that is 22. Is it 22?
Yeah, 22.
Then you subtract the estimate in year 3. Is it? Okay. That is 240 employees. So we need to understand the language of the examiner. And we do this by doing a lot of numbers. The more we do numbers, the more we understand these tricks. Okay, I believe once you have the remaining employees, other things remain the same. Okay, so we are done with Roman 2, rather question 2, because once you have remaining employees, you just follow this. You just get cumulative employees, then you account for each year. Then the next question Next question, yeah. Now, next question, it's what I'm interested in. You see, this next question is not talking about share option. It is talking about what? Cash share appreciation rights. Okay, so let's see. Let's look at this question 3. They are telling us we show the accounting treatment of the above SARS, that is share appreciation rights, in accordance with relevant IFRS. Of course, here the relevant standard is IFRS 2. So we are going to write something here. We are going to, before we write something, you need to know that here we are dealing with share appreciation rights, not share options. And because you're looking at cash share appreciation rights, these ones will result into what? We said they will result into what?
Expenses and liabilities.
So let's do that. Let's write something. Then after that, we'll read the question. This is question 3. Question 3. We are going to say that share appreciation rights are examples of cash settled share based payments that result into employee expenses and employee liability. And IFRS 2 requires an entity to measure cash settled share-based payments using what? We said we use what? Using fair value of the rights at what? At each reporting date. Here we are not talking about grant date. We are talking about the reporting date. So therefore, you start. How? But now, here, of course, we will also need to determine the remaining employees for each period. We need to determine the remaining employees for each period. But let's go back at our question. Question 3. They are telling us that on 1st January 2018, BUL, that is BUL, granted 1,000 cash share appreciation rights to each of its 400 employees on condition that the employees continue to work for entity, not equity, for entity until 31st December 2020. So how many years? Here, the vesting condition is that you work for this entity for how many years?
3 years.
From 1st October to 31st December 2020. How many years? Are they 3?
3 years.
Yeah. So after 3 years, you qualify. Okay, let's continue and see. During 2018, 25 employees left the company, and BUL estimated that a further 50 employees will leave during 2019, and and 2020. Okay. So can we get the remaining employees in 2018? In 2018, can we get the remaining employees?
Yes.
How? We get total
Simple.
employees, how many? 400 employees minus employees that left in 2018. How many are those? 25. Okay? Then we subtract the estimated number of employees that are expected to leave in the remaining period. That is 50. What do you get?
325.
Yeah, you will get 400 minus 25 minus 50. Okay, that is in 2018. Okay, let's continue. Next period, they are telling us that during 2019, 30 employees left the organization, and BUL estimated that a further 15 would leave during 2020. Okay. Remember, when you're dealing with this question, you are ideally looking at the vesting period. We don't look at the period beyond the vesting period. Vesting period, it's from 1st January 2018 to 31st December 2020. That is your vesting period. That is the period you will be focusing on as you get your vesting fraction. Anything above that, you will not be talking about vesting fraction. No. Okay, so during the 2019, 30 employees left the organization, and BUL estimated that a further 15 would leave during 2020. Okay, how do we get the remaining employees? In 2019, who can tell me? How do we get this?
Have the 400.
We are going to
minus
get the
actual,
total employees minus the actual
2018. So it's
employees
25.
that left in 2018. That is
25.
minus
30.
the actual employees that left in 2019. Because 25 employees, those are actual number of employees that left in 2018. What about the actual number of employees that left in 2019? How many?
30.
30. Then minus the estimate.
So
Estimate
15.
is what? 15. What do we get? 400 minus 25 minus 30 minus 15. Then we next that is 2020. Let's go back at our question and we see what are they telling us. During 2020, 27 employees left the company. At 31st December 2020, remember, this is the last date. This is like a time when this is like a date when these guys should exercise their right. At this point, they can exercise their right. Employees can exercise their right. Okay, but before this date, you cannot exercise your right, you as an employee, before this date, because you have not yet met the condition to remain in the company for 3 years. But at this date, you can exercise because 3 years are done. And that's why they are telling us that at 31st December 2020, 120 employees exercised their rights, their share appreciation rights, with another 135 employees exercising their share appreciation rights at this date, while the remaining employees exercised their rights at the what? So it means that after this date, even on this date, you can start exercising your right. And we are going to see the impact of that. We are going to see the impact. Exercising right means that now here you are the company, you can pay me cash. You can pay me my cash. You can pay me my cash. I need my what? My cash. You can demand what? Your cash. So we are going to see the impact of that. You have the right to demand your cash because you have met the condition. Okay, so let's see now the impact. Remaining employees now in 2020. Let's first get the remaining employees in 2020. We are going to get total employees minus employees that left in the actual employee that left in 2018, that is 25, minus actual employee that left in 2019, that is 30, minus employees that left in 2020. How many?
27.
27. What do you get? Okay, so that's what we have. From there, you can get your cumulative. Here it's cumulative expenses, stock liability. Because you're dealing with share appreciation rights, cash settled, results into employee expenses and employees' liability. The first one, we said a cumulative employee expense stock equity. So the formula is going to remain the same, but there are some things that are going to change. Here, where you have fair value of share option, okay, let me write here. The formula will be equal to, we are going to get the remaining employees. Then we multiply by number of, or you can start with fair value depending on what you want. It doesn't matter. Order doesn't matter. The fair value at each reporting date, then times vesting. Times number of SARS. That is number of rights. Share appreciation rights. Then times the vesting fraction. Okay, we start with the first year, that is 2018. Remaining employees 325 times what is fair value at reporting date. What is the fair value? Let me see. Are we given fair values? The fair values of the SARS for each year in which a liability exists are shown below. So the fair value for 2018 is 1,400. 1,400. Then times number of SARS. How many? How many share rights? How many appreciation rights? Sorry.
1,000.
1,000. Then times the next is what? Times the vesting fraction.
1/3.
From this period, this is the first period up to the last date. the date you're supposed to exercise your right. Your remaining your remaining is how many years? Or in the total. In the total, we have 3 years. For you to start exercising your right, you have 3 years. So here, what do we get? Remember, what we are getting here is shillings, okay? So what do you get?
I think, should we round off to 1,
Pardon?
5, 2,
You get 1 5?
2M. 1,
1
5,
5
2,
1?
1. Okay.
Is it 1 5
52
1.7?
million.
Can we do 1, 5,
Or
2M?
150?
52 million.
This is
2M.
this is wrong, right?
It's correct, but we can say 152M.
152 million, yeah?
Yeah.
Okay, it's okay. Okay, next. For 2019, the remaining employees 330 times at reporting date. At reporting date, what is the fair value? 2019.
1,500.
1,500. Then times the appreciation rights remain the same. 1,000 times here, what is the vesting fraction? 2 out of 3. What do you get?
330M.
330 million. Now, at this point here, colleagues, you see that here, when you look at the question, in 2020, you have a number of employees at 31st December 2020. You have some employees that exercise there.
Their rights.
You have some employees that exercise their rights. Okay, so what are you going to do here? We are going to say, of course, here the remaining employees here. The remaining employees are, remember the remaining employees are what? 318. Out of 318, we have employees that exercise their rights. Okay, so you are going now to apportion here. You are going to apportion in year 3 in 2020. In 2020, you are going to apportion. You are going to look at those that exercise their rights, those that exercised their rights. Remember now, when employees exercise their rights, it means that you are the company, you are paying these employees cash, okay? So we want to know how much did you pay them, okay? So to know that, you're going to get the number of employees that exercise their rights. I think they are 120 from our question, okay? Then we multiply by, you multiply by the options, share appreciation rights, 1,000. Then you multiply by the intrinsic value. You don't multiply by the fair value at reporting date. Employees that exercise their right, we value the shares using, here you will use intrinsic value. For those that exercise their rights. Okay, so you're going to get 120 times the number of share appreciation rights times the intrinsic value. In 2020, what is the intrinsic value? In 2020, what is the intrinsic value? Let me see.
1,500.
Now it will not be this. Yeah, we are still in the 2020. Yeah, it is 1,500. Sorry. 1,500. What do you, here you are not going to multiply by any vesting fraction because employees have met the condition. Here with vesting fraction, you're looking, you use that fraction when the time to exercise right has not yet reached. Here they have ideally exercised their rights. So what do you get here? How much? How much? If you multiply
180
how much?
180.
180 million. So it means that the company is going to pay these employees 180 million as cash. Okay, so their cash or bank account must reduce here. Okay, but still in 2020, we have those that did not exercise their right, not exercise. We have those that did not exercise their rights. But now how can we get the amount here? Of course, those that have not yet exercised their right as the company, you still have a liability. You still have a liability to pay for those that have not yet exercised their right. So we want to know what is that total liability. How many? How many that have not yet exercised their rights?
It is 318
Remember, in year
minus
3, we had what? We had the 318. So you get 318 minus those that exercised rights.
180.
Then we multiply by what? The rights. Then times what is, remember, for those that have not yet exercised their rights, we use the reporting, we use the fair value at reporting period. And in 2020, what was the fair value at reporting period? In 2020?
It is 1820.
1820. Perfect. Times the vesting fraction. 3 out of what? 3 out of 3. What do you get?
360.4.
360 million.
0.4.
Okay. 0.4.
Yeah.
If you want to maintain a point, you can put even here. Then you should bring a point because this was a point. It was 51.7. You should be consistent. If you choose to use the whole number, use the whole number.
There you cannot use the whole number because you have 360, 360.
Pardon?
It is like the whole number is 360,000. So if you
Okay, let's go with this. Okay. So we are done with the 2020. But remember our question, we are supposed to account. Remember, they are telling us that BUL has approached you for guidance on how the above share appreciation rights should be accounted for in each of the 5 years. It's not only about the vesting period. Here you are looking at even the period above vesting period. Okay, so we are going to continue. That is in year 2021. In year 2021, what are you going to do? Remember, they are telling us that we are done with 2020. They are telling us that another 135 employees exercising their share appreciation rights at 31st December 2021. So we are going to also, now when you're handling 2021, the question is, what is the remaining in year 4, in 2020, in 2021? What is our remaining employees? Remaining employees. Remaining employees, still you have 118 minus 120. Those that have not yet exercised the rights. And how many are those? 198 employees. These ones have not yet exercised their rights. Okay, so in 2021, you needed to deal with also those that have exercised their rights. So you're going to get how many? How many that exercise their rights? 135. 135 employees times 1,000 rights times the intrinsic value. What is the intrinsic value in 2021?
2,000.
2,000. And how much do you get? It means that here, as a company, you must pay cash.
270. 270 M.
270 million. Those that have not yet exercised, you still have a liability as a company. So you determine that liability. Not exercised. You are trying to get how much should you pay as cash. How much should you pay for these that have exercised? Then for those that have not yet exercised, you look for the liability, because as a company, you still have a liability to pay. So how many have not yet exercised? You get 198 minus 135. Then we multiply by what? We multiply by the number of share appreciation rights times the reporting. For those that have not yet exercised, we use the fair value at reporting date. And what was the fair value at reporting date?
2140.
2001, 140. Here you don't have vesting fraction. Hey, here you don't have the vesting fraction. That fraction stopped in 2020. So you don't need to look at that. What do you get?
You get 134.8. 134.8 million. So this is like a liability. This is a liability. Next, that is in 2022. That is our last year. Before you look at 2022, you need to know what is the remaining. Those that have not yet exercised their rights, remaining employees. Of course, this is 198 minus 135. What do you get? 63.
Yeah, 63. 63 employees have not yet exercised their rights. So we go back to our question. They are telling us that while the remaining employees, now they have not given you the actual number. They are just saying while the remaining employees exercise their SARS, their share appreciation rights at the end of 2022. So it means that at the end of 2022, you don't have any employee that has not yet exercised the right. Okay, so you are going to just simply get the amount of money you paid, the actual cash you paid for those that exercise. That is 63 employees, because that is the remaining number. Then times the share appreciation rights, time what is the intrinsic value in 2020?
500.
2,500. What do you get?
157.5.
157.5 million. For those that have not exercised, nil. Not exercised. Not exercised. It's nil. Okay. And you're done. You're done. What is left is to account how much should be reported for each year. Remember, these figures are cumulative. So you need to know for each year, what should you record? So we are going to say that for each of years 1 to 3, we start with the vesting period. For each of years 1 to 3, that is 2018 to 2020. Which company is this? Is it BUL?
Has no name.
Is it BUL?
Yeah, VUL.
BUL should recognize employee costs with the corresponding increase in employee liability as below. Okay, so in 2018, here we are looking at accounting treatment. Ideally, we are looking at the accounting treatment. How should we recognize? What should we do?
We debit.
In 2018, what should we do? Remember, in 2018, we have what? We have this amount of money. Here,
Yes.
employees have not yet exercised their right. It is still a liability. Okay, so you do what? Remember, we say that we have two things, expense and the liability. So what do we debit? What do we credit?
We debit profit or loss. We credit liability.
We debit our profit or loss account. These are just employee costs or employee expenses with how much? With shillings 151.7 million. And credit what?
Liability.
Credit employee liability. That is a liability. And you're done with the first year. Then in 2019, you are going to debit what? Debit the increase,
Yeah.
because here still in 2019, employees have employees have not yet exercised their rights. So this is still a liability. Initially in 2018, you had a liability of this. It means that it is still in your book. You just recognize an increase. In 2019, you recognize an increase. So what is that increase? So here we are looking at an increase. 330 million minus 151.7. What do you get?
17,8.3.
178.3 million. And you credit, a liability has increased, so you credit still a liability. Then in 2020, in 2020,
Exercised, right?
okay, so here you have to be very attentive. You have to be very attentive. What are you going to do?
We first look at those ones that did not exercise.
Remember, if employees exercise their rights, you're paying cash. Automatically, you must credit your cash. You must credit, if you want to start from there, you must credit your cash. It can be cash or what? Or bank.
Bank.
How much? For those that exercise
80 million.
180, okay? So we credit 180 million. What else? Because we have also those
Liability.
that have not exercised their rights. This is a liability. What do you do with a liability? Remember, in your book, you have a liability.
Reason.
In your book, you have a liability of how much? Okay. Okay. If you do this, let's see. If you credit cash, it means that here you are debiting something. You're debiting what? You're debiting profit or loss. The first amount is 180 million. Then plus. You need to be very attentive. We have those that have not yet exercised their rights. This is still a liability. Do you agree, colleagues?
Yes.
This is a liability. Remember, in your book, you had a liability of what?
330.
Of 330. It means that a liability has increased. But for you, you capture, in 2020, you capture an increase. So what is that increase? Get this minus this.
30.4.
What do you get? So here you're going to add an increase in a liability is an expense. So what are you adding?
30.4.
You just tell me the final figure. What is the final figure?
30.4.
It's shillings how much? If you get 180 plus an increase in liability, what do you get?
210.4.
210.4 million. It means that there is a liability you must recognize. So we credit an employee liability. That is an increase in a liability. And that increase is of how much? It's this 0.4 minus. And that is shillings at 30.4. And you're done with the 2020. Okay. Then in 2021, okay. Okay. What are you going to do is 2021?
It is still cash
It is still
of
the
270
same.
million.
It is still the same, 2021. You can start with the easier one.
It's
You
still
credit,
cash.
you first remove that cash. First pay, credit cash, how much?
270.
270.
270. 270 million. Then do we have a liability? Do we have a liability in
Yes.
2021?
Yes.
Yes.
This is a liability. Has it increased or reduced?
Reduced.
Remember, you had a liability of this. Now the liability is this. What happens if there is a decrease in liability? What do you do? It means that your liability has reduced. You must debit. To reduce the liability, we debit the liability account, isn't it?
Okay.
So here you could debit. You could, to reduce the liability, you debit what? Employee. Don't rush to write. Let's first summarize this. You debit employee liability. Here you are trying to reduce the liability. By how much? This liability has reduced by how much?
225.2. 225.
Is it 22?
225.
5.2.
Isn't it?
0.2.
Okay. This is wrong, eh?
0.2.
This is 0.2, eh? Okay. Next. We are done with this. We are done with the liability. You have paid. Remember, you have paid the cash. It means that also here you have to debit. You have to debit the profit or loss account. By how much? By this cash. Okay. Do we have any other item that we must talk about? Here you have exercised. Sorry. You have exercised this. You have a liability of this. It means that you have an income. A decrease, colleagues, a decrease in liability, this one. This is a decrease in liability. It's an income. It's an income in your books. It will be an income, so you credit. Remember, an income must be credited in our profit or loss. So credit PL account with an income, this one. From our transaction, this is what we should do. But of course, if you have similar account in one transaction, you net off. You net off. You net off. How do you net off? You look at which side is higher. You see here we have a debit of 270. Here you have a credit of 225. So if you are to net off, you are going to write now in summary, here you are going to debit, because the debit side is higher. You are going to debit profit or loss account with, if you net off, it is 270 million minus 225.2 million. What do you get?
44.8.
You get 44.8 million. Then you debit also, you debit employee liability with this balance. Then you credit your cash with shillings. This one, I believe, if you add a debit and a credit, you must get the same answer. This is shillings to 5.2 million. And this is shillings. What is it? 44.2 million. I believe if you add this one plus this one, you get
44.8.
Do we have something that we have missed?
It's balancing.
Is it balancing?
Yes.
44.8.
This is 44.8. I was wondering. Okay. It must be balancing. Okay. So that's what you do in 2021. Okay. So in 2022, I believe now you can answer that. In 2022, you do the same. In 2022, here, employees exercise their rights. It means that this is cash. Company paid cash. So you credit what? You credit cash. You credit cash with how much? Cash account. With how much?
157.5.
Shillings 157.2. We have any point? 0.5. If you do that, it means that you're debiting what? Remember, what are you paying? These are employee costs. And it means that you're debiting profit or loss account. These are employee costs. These are expenses. Okay. Do we have any other item that we must recognize? Do you think that you have any item that you must recognize? Remember, in 2021, colleagues, in 2021, you had a liability. Are you saying that? You had a total liability of this. You had a total liability of this. And now in 2020, there is no what? There is no liability. So it means that liability has your liability has reduced. So you must recognize, you must remove the liability from your books. How do you do that? Recognize the liability by debiting the employee liability. Employee liability of how much? Employee liability has reduced 130 shillings, 134.8 million. A decrease, this is a decrease in a liability. A decrease. And a decrease in liability is an income. So you credit profit or loss account with a decrease. This is a decrease in liability. But because this is one transaction, we don't expect two accounts. You can net off this one, net off this one with this one. Which side is higher? So it means that here debit side is higher. So we are going to debit. We are going to debit. We are going to debit profit or loss account with how much? The net amount minus 134.8 million. What do you get? Hey, here there is a 0.5.
23.
Pardon?
Wait a minute.
22.7, eh? That's what you have. Then, what else we debit? We debit this. We debit employee liability with the shillings. This. I believe if you add, you get the same. The debit side must be equal to the credit side. So we credit cash or bank with this one. If you add, do you get? Is debit side the same as credit?
Yeah.
So colleagues, that's how you account. That's how you account. Just maybe here we should do change for each of years for each of the years. Since I have done everything, for each of the years, Guru should recognize employee cost with the corresponding increase or decrease. Okay. Any other question? We are done with this. We are done with share appreciation rights. We are done with share appreciation rights. We are, I think, from our part, we are done with this. We are left with how to deal with deferred tax implications and repricing of shares. Let's use just a few minutes. I know you're tired, but let's use a few minutes to talk about this. It doesn't take a lot of time. Remember, we don't have time. Tomorrow we are looking at another standard. I will talk about this repricing of share. Then I introduce another standard, that is the employee benefit, IS 19.
Maybe we can change on the time we start.
We are going to talk about that tomorrow. So let's talk about this, how to deal with deferred tax implications of share-based. Now, colleagues, we are done with question 3. You will use the same knowledge to answer question 4. Please, you do. It's the same thing you try to do on your own. Question 4. Let's look at question 6. Let's look at question 6. They are telling us that on 1st January 2020, Moore granted 10,000 shares, 10,000 share options to each of its 10 directors vesting 2 years later. That's a point you can start. After 2 years, you can start exercising your right as a director. Okay? The fair value of each option at the grant date. Here we are talking about grant date because it's share option, equity settled. Okay? The fair value of each option at grant date was shillings 2,500, and the tax authority in Uganda allows as a tax deduction of the intrinsic value of the options on exercise. The intrinsic value of the share options was shillings 2,100 at 31st December 2020, increasing it shillings 2,250 on the exercise date. The income tax rate in Uganda is 30%. So they are telling you you show how Moore should account for the deferred tax implications of the above transactions for each of the 2 years. And now for this one, it's very simple. Deferred tax implication. You look at two things here. One, for tax purposes, the carrying value of the share option is reduced to 0. Why? Why is it reduced to 0? It's because these guys cannot exercise their right. They cannot exercise their right until that date. Eh? So you need to, and remember, it's until that date when you can claim. It's until that date when you can start claiming the tax expenses. Okay. At the date you start exercising your right, it's the date you should start claiming the tax relief. Okay, so that's why we must reduce the carrying value of share option to 0. These options are not tax allowable until employees exercise these options. Minus that, there is no tax allowance here. Okay, then number two is that the tax base, remember, deferred tax, you are looking at carrying value, compare it with the tax base. So the tax base here, the tax base of share option, the tax base of share options is calculated using the intrinsic value. Colleagues, know that the reason why we are looking at this is that because share options result in employee expenses. They result into employees' expenses. But when can this person start claiming this deduction. Okay. Okay, so how can we do this with these two conditions? How can we now know the deferred tax implication? We have 2 years from our question. We are going to say therefore, let me make a table. Let me put a table. We have details. We are looking at the first year is what? The first year is what? The first year is 2020. 2020 and 20. We are looking at only 2 years. 2020, 2020, and 2021. So you can make that a template. So we are going to look at the carrying value of share options. And we have said that you reduce, for tax purposes, you reduce the carrying value of share option to 0. So here you put 0, also here you put 0. Then for the tax base of share option is calculated using intrinsic value. So here we need the tax base of share options. So let's do the working. For you to get the tax base of share options, you need the remaining employees. And for 2020, ideally, do we have any, let me see, do we have any employee, any director that left? They just said 7 directors. Okay, here we don't have any director that left. So in 2020, you have 7 directors. You have 7 directors. And also in 2021, you have 7 directors. Okay. So what is the tax base? We need to know what is the tax base in 2020. How do you get the tax base? You follow the same. Remember, this is the share option. So you get the number of employees, number of remaining employees, which is 7, times number of share options. In the question, how many share options? How many share options? From our question, Amur granted 10,000 share options. So we are going to multiply by 10,000 share options times. We are saying that when you're determining tax base, you use intrinsic value. So we are going to multiply by the intrinsic value. What is the intrinsic value in 2020? The intrinsic value of share options was shillings 2,100. That is at 31st December 2020. 2,100. times the vesting fraction, 1 out of 2. And what do you get? What do you get? What do you get? It is shillings. What do you get? What do you get? Shillings. Do you have 73.5?
735. Is that 21
Okay.
or 2001?
Ah, yeah. Sorry. Here it is 2,100. Then what about the tax base? What about the tax base in 2021? The remaining directors 7 times the share options 10,000 times what is intrinsic value in 2022? 2021? The intrinsic value, increasing 2, it means that is the very intrinsic value. So that is 2,250 times the vesting fraction, 2 out of 2. What do you get? This is shillings.
157.
157.5.
5.
Okay, all right. So it means that here you're going to put 73.5. Then here maybe you can keep your millions, figures in your millions. So here. Then here it is 157.5. Compare the carrying value with the tax base. Remember, if the carrying value from our income tax from ISC, IS12, if the carrying value is greater than the tax base, what do you get? The difference is what? The difference is what?
Deferred tax liability.
Yeah, it is a deferred tax liability. Then if the carrying value is less than the tax base, the difference results into deferred tax asset. The difference results. This is like a temporary
deduction.
Okay. So here, do we have a deferred tax asset or deferred tax liability? So the difference is deductible, temporary deductible difference, which results into no, you don't need to put
asset
negative. Just this one results into an asset, okay, deferred tax asset. So here you will determine deferred tax asset, whereby deferred tax asset is tax rate 30% times the deductible temporary difference. This is 30% times your difference. And also here it's 30% times our difference. That is our deferred tax asset. So it means that finally, for each of the 2 years, what is the name of the company here? For each of the 2 years, move. For each of the 2 years, move. Should recognize increase in a deferred tax asset as an income in the profit or loss account, and corresponding increase as what? As a non-current asset in the statement of financial position as below. Year one, what should you do? 2020, you debit what? You debit an asset, debit deferred tax asset with how much?
$73.
Shillings, are you sure? 2022, deferred tax asset is 22.
Sorry, 22.
22.05 million. Then credit what? This is an income. Credit, tax credit. This is like a tax credit. Profit or loss account. This is like a tax credit. Yeah? Then in 2021, what are you going to do? You look for the increase. You debit an increase. Debit deferred tax asset with an increase. An increase is of how much? The difference between 70, or rather 47.25 million minus 22.05 million. What do you get? Because already this is new records, so you just capture
25.
the increase. Okay, the shillings 25.2. And the credit PL, the tax credit has increased also. Yes, yeah. That's all about this number, question 6. This is all about question. Was it question 6? This is all about question 6, yes. Any question? We are done with this number. You try question 7 to understand deferred tax implication. Try question. You try question 7.